Pull the trigger.
How's it, traders, and welcome back to Paradigm Flip. Hope you're all doing well. In this video, we're going to take a look at how we may quantify how extended price is from its moving average in order to better determine when we can time a reversal trade or when we should be staying out of a trend altogether. So if you all remember, in my last video, we spoke about this idea of price being extended away from its moving average. And we basically spoke about this idea that when price is away from its moving average and we see the space between price and its average, right? The greater this space between price and its average, the higher the probability that price will revert back to its average, right? And we touched on the idea that when we see the space between price and its average, when this space is large, right, it's better off not to look for trend continuation patterns at all, right? And rather look for reversal patterns, right? And trade back to the average, because the higher probability setup is that price is going to revert back to its mean. Right. Now, if you haven't watched that video, I suggest you go and watch it. I'm going to link it on the top here. Right. Go and watch that video before watching this one for greater understanding and context of what we're going to be touching on in this video. Okay. So we spoke about this idea, right? But how do we actually quantify this space? Okay. And how do we actually know when price is extended enough, right, to revert? Because price could move away from the average, right? As you can see, price is away from the average, right? But when's the right time, right, for price to actually revert back? When's the most likely or most probable time that price will revert back to its mean? Okay, and that's what we're going to be looking at in this video. Now, in trading, we have to quantify what we are doing so that we can find patterns, consistent patterns, right? And we need to have an idea of the statistical significance of what we're doing, right? So if we want to trade back to the moving average, if we want to look for these kind of setups, right, and find the trade back to the average, right, we need to be able to quantify the space between price and the average and understand when price is extended, okay, in those scenarios, at what level of extension, right, is price most likely to revert back to the mean, right? So the pattern that we are looking at is this pattern of price moving away from its average. If I just draw this, if we have our moving average here, okay, and we have price, right? So the pattern is we are looking at price moving away from its average and trading back to its average, okay? And we can see that in these scenarios, right, price also moved away from its average and back to its average, okay? But this distance is obviously too small, right, for you to trade a reversion trade, because there's a possibility that we might not get this pullback and price may continue to drop lower as it did in this area, okay? If you are anticipating a move back to the average, right, at this point, okay, because price did the same thing over here and here, right? So the distance between price and the average at this point is fairly the same as these previous 2 points, okay? So you could expect price to move back to the average, but instead it continues to drop, and it drops a lot, okay? These moves would be considered too small, right? And we really want that space between price and the average, okay? But in order for us to understand that, we have to be able to quantify this space between the average. And then we have to look at the level, right, that is most appropriate, okay, to be actually looking for a reversal trade, right, once we get the move away from the average, okay? And in order to do that, right, I'm going to introduce you to a tool that you might have seen me use previously in my previous videos. And if it's your first time to view this tool, right, I've also done other videos on it, so you can search my library on YouTube and you'll find other videos surrounding this tool, right? And the tool that I use is this little indicator here, right? And basically it is a MACD, right, with a Bollinger Band on the MACD, okay? And the MACD is telling us the difference between price and the moving average, right? So when price moves away from the moving average, right, as it did here, you can see the MACD is going down. And when price is moving back to the average, right, the MACD is going up. Okay, so we've put a Bollinger Band over the MACD, right, with a high period. And basically what the Bollinger Band is going to do, it's going to give us a statistical measure in terms of standard deviations, right, of how far extended price is from the average. Now, I've also touched on standard deviations and its importance in trading, right? And we can just touch on it a little bit here because it's very important, right? So we're going to be going over the boring theory for a little bit, right? But bear with me because this is the important stuff. Now, let's just say we have a simple bell curve, right? Now, in statistics, right, this is called a normal distribution, right? And it's a distribution that could show anything. In this case, we are basically looking at the distribution of price, right, around this 20 EMA, right? So this would be the mean, okay? And basically this mean would be your 20 moving average, okay? And coming out, right, we would have one standard deviation, and then we would have two standard deviations, right? And then we would have three standard deviations and so on, right? So you would have your one standard deviation, right? You would have your two standard deviations, and you would have your three standard deviations, and so on. And then this would be your mean, okay? Now, when we're looking at standard deviations, right, what we are basically looking at is where price falls, right, or how price is plotted around this moving average. Now, if we look at the peak in the distribution, right, this is a place where the data is most frequent, right? Meaning that price most of the time will be near the 20 moving average, okay? And the first deviation away from the mean, right, whether it's to the upside, right, so that would be this area, right, or to the downside, that would be this area, right, accounts for approximately 70% of the data, meaning that price fluctuates 70% of its time. Price is going to remain within one standard deviation. Now, as we go down this curve, right, and we reach two standard deviations, right, we can see that the frequency of occurrences is going to be less, right, when price is in these areas, okay, and it's going to be, if I'm not mistaken, 13%, right, on each side, right, to the upside and to the downside, right, and this means that 26% of the time price is two standard deviations away from its mean, and it's going to decrease in frequency as we go to three standard deviations and further. So price spends most of its time within the first standard deviations, and it spends less time when we move out, right, into two standard deviations and three standard deviations and so on. So this is a statistical fact, and when we are actually looking at this, what we're actually trying to do is identify what's normal and what's not normal. And when we're actually looking at this, if we can just draw a moving average here, right, what we are saying is that 70% of the time, price is going to move within one standard deviation away from its average, right? And 26% of the time, right, price is going to move two standard deviations away from its average. And this is normal and this is abnormal. So when we see abnormal, we can expect price to revert back to behaving normally. So when we are 2 standard deviations away from the average, we can expect price to move back to its mean. At this point, we can assume price is overextended. And in terms of the trading side of it, right, there are going to be less interested parties looking to buy an extended move away from the average. This area, right, will be a profit-taking area and a candidate for short opportunities, right? So if you are buying in this area, there's a very high probability, right, that you'll get stopped out, and there's a very low probability that price will continue to extend. And at the end of the day, we are dealing with markets, so it's important to remember it does not mean that price will not extend, right? But we are anticipating a reversal, right? Because more often than not, right, when we are 2 standard deviations away from the average, right, price is going to revert back to doing what it does most, okay? Because we've identified that 26% of the time, right, price is in this region, right? And approximately 70% of the time, price is within this region from the average, right? So based on that, right, we can assume that price is not going to continue extending away from the average. But it does not mean that it can't or it won't, right? But we're going to play the probability that it won't. And more often times than not, right, you'll be correct. So if we come down and have a look at our indicator, right, our Bollinger Band is set to 2 standard deviations, right? 1 standard deviation would be half of this and would be around this area. Okay. So most of the time, price is within this range from its average, right? And when we see a move down to 2 standard deviations and beyond, right, we can assume, right, that the trend is most likely not going to continue, right? So this is a signal, right, to either stop trading trend continuation patterns, right, or look for the reversal trade. Okay. And you can see from this point as price moved lower, okay, and we reached a 2 standard deviation point at this point, right? From this point, right, you can expect or anticipate a reversal back to the average, right? And that's basically how you're going to quantify, right, the distance between price and its average, right, in order to anticipate a reversal. Now, we can look at a number of these, right, to see if this holds true, okay? And we can see the first one, right? Price reached 2 standard deviations, right? And we got that reversal. And if we just scroll on, okay, we can see at this point here, price reached 2 standard deviations, right? And we saw that reversal back to the average. And we can see at this area here, right? Price broke below the 2 standard deviation area, and we can see that price reversed back to the average. In this area as well, we can see we had a 2 standard deviation move away from the average, right? And price pulled back towards the average, okay? In this area, we had a 2 standard deviation move away from the average, right? And we can see that price played a bit at the top and then reversed back to the average. Now, in this area, we can see that price exceeded a 2 standard deviation move, and this was a persistent move, right? So that goes back to that point that I brought up, okay, that it doesn't mean that price will reverse on a dime when we reach this 2 standard deviation mark, right? Because trends do persist and we could get that persistence. Okay, but the nice thing about this indicator is that it's twofold, right? It's quantifying the distance between price and the average, and it's also acting as a momentum indicator, right? So when we see that move, that 2 standard deviation move away from the average, right? What we actually want to be doing is waiting for a reversal pattern, right? And we can actually see that momentum slows down once we get this divergence, okay? And you can actually wait for the divergence, right, before you take a reversal trade, right? and you see that we get that move back to the average. Okay, when we move on, right, we can see that price moved away from the average, right, a 2 standard deviation move, and we get a move back to the average. And you can see that, and we can see that oftentimes when we get that 2 standard deviation move away from the average, right, it's very common for us to get an instant reversal, right? So if you are waiting for a divergence in this area, you might have missed the move. Okay, right. But at the end of the day, you're looking for that reversal pattern. Okay. And see in this area, price didn't reach 2 standard deviations anyway, right? Same here. You can see more often than not, price is operating within that 1 standard deviation range, right, away from its average. If you look in this area here, we got a 2 standard deviation move away from the average, right? Price doesn't reverse instantly. We play around the 2 standard deviation mark, right? And then we get a reversal back to the average. We get a 2 standard deviation move away from the average in this point here, and you can see price reverted back to the average, right? So this trade is the trade that you're looking for, okay? Right? And these are not small trades, okay? If we just look at how many pips this is, right? That is a 38 pip move, okay? And this is a 48 pip move, right? So these are fairly good and decent day trades, okay? And we can see in this area here, we get another trend that persists, okay? We get a 2 standard deviation move away from the average, right? We get this pullback here to the average, okay, on this bar. And we can see that we have some tension on the average, okay, right? Price is holding, right, this tension, okay, the space between the average. And we can see that once we start to see divergence, right, the trend slowing down, okay, we get that move back to the average, right? We can see in this area here, price moves away from the average, right? We got a 2 standard deviation move from the average, and we move back to the average, right? And that would have been a 40 pip move, okay? And we can see our price moved away from the average, right? We got a 2 standard deviation move in this area here, and we can see that price doesn't revert back on a dime, right? We get one more higher high, right? We get that divergence, okay? And then we get that move back to the average, okay? And that would have been a 38 pip move, right? And all the way back to the average here, right? That would have been 31 pips, okay? And in this area as well, we can see price moves 2 standard deviations away from the average in this point here, okay? And we can see that price forms a high, right? We get a bit of divergence here because price comes back and touches this high, okay? But on the MACD, we got a lower high, right? So we got a bit of divergence in this area here, and we can see price moves back to the average, okay? And we can see another one in this area here, okay? Price moves away from the average, right? And you can see ultimately the strength of the trend is decreasing because we got a higher high in price, but price ultimately also, but the MACD also has created another lower high, and that's telling us that this trend is slowing down. Nonetheless, we get a 2 standard deviation move, right, on that move up, right, and we can see price moves back to the average at that point there, okay? And this move would have been 38 pips, okay? And this move would have been about 33 pips, 34 pips, okay? You can see there's no trades there. And as we go on, we can see price comes very close, right, to 2 standard deviations, right, and we move back to the average here, okay? And we get a 2 standard deviation move away from the average at this point, okay? And you can see we move back to the average at that point there. Same thing here, we get a 2 standard deviation move on this candle here away from the average, and you can see we move back to the average on the next candle. Very fast movement, right? We get a 2 standard deviation move at this point, right? And you can see this is a very strong persisting trend, right? And in these situations, we're waiting for the divergence on the MACD to show us the trend is slowing down, okay? And then we get a move back to the average at this point here. Here we get a 2 standard deviation move away from the average at this point, okay? And we get a little bit of persistence, okay? We can see that divergence coming in at this point here on the MACD, right? And then we move back to the average at this point. And then on this area here, right? We came very close, right? 2 standard deviations, okay? And you can see we got a small pullback to the average at this point here. Here we had a 2 standard deviation, a move away from the average here, right? And we can see we instantly moved back to the average. And then in this area here, we had a strong move, right? We moved away from the average, okay? And we're getting small little pullbacks in this area, right? And I'm saying small, right? Because compared to the initial move, right, they look small, right? But these pullbacks are quite decent. So if you had to try and enter on these pullbacks, I'm sure you would have been able to move to break even, depending on how good of a trader that you are, right? But ultimately, we see the trend slowing, right? We get that divergence in the MACD, and you can see that, well, based on this was an open. You can see price gap down back to the average, okay? And in this area here, we get a 2 standard deviation move away from the average, right? And we instantly come back to the average. And in this area here, again, right? And we see we get that persistence. And if we just look at the MACD indicator, right, the highest peak on the MACD, right, was at that point, and we can see that the next data point was a lower high, right? So we got that divergence in this area here, right? And we ultimately move back to the average, okay? And here we don't get anything. In this area, we can see we have a very strong move, right? And we start to get that divergence, okay? And we move back to the average. In these areas here, you can see we get moves away from the average, right? We get these pullbacks that don't reach the average initially, okay? Besides this movement here, this one came close to the average, okay? But sometimes you will get moves like that, right? Because initially, what could happen is that when we have a strong move away from the average, right, price could ultimately consolidate, right? And that is also a reversion back to the mean. Okay, so it's just important to also recognize that you won't always get a straight drop. Okay, and that basically concludes the backtesting, right, of we can say the most recent data on price action. Okay, and you can use these ideas as building blocks for trade strategies, right? You don't have to use it in this way. You can use it in your own way. Okay, and I hope this video added value to you, right? Go and test these ideas out for yourself and come up with your own conclusions, right? And if you liked the video, please hit the thumbs up, and if you enjoy the content, subscribe for future content, and please leave a comment about your thoughts and opinions and ideas below, right? It's all appreciated. And until next time, see you on the flip side.